Well, in the political quest to place blame for high energy and food prices, regulators are now starting to point fingers at various market participants like some of the traders, the index funds, the pension funds, those big bucks investors who now have moved into the commodities markets, seeing an opportunity there.
It used to be so easy. We would just talk about speculators, but now there are even different kinds of speculators, and one speculator says they're better than another kind of speculator.
And earlier this week, the nation's top commodities cop, the CFTC, announced a new set of rules designed to rein in some of those parties. Smart move, or is this simply government gone wild? A difference of opinion now from Cameron Hanover, President Peter Butel, and Don Luskin, who's Chief Investment Officer at Trend Macrolytics. And Don, you think it's nonsense to try and regulate this, right?
I think there's good regulation and bad regulation. Good regulation is the kind that increases market transparency and disclosure and lets people know who's doing what. Bad regulation is where you take people as a class and say, you get to participate in these markets, you don't, you get limits, you don't, you're a crook, you're good. Those are the kinds of discriminations that regulators do not know how to make, and they make markets malfunction.
But Peter, you say a pension fund, for example, has no business being in the commodities markets.
I don't think they have. You know, a pension fund or a college endowment really should be playing, you know, ExxonMobil or another stock rather than trading energy futures. You know, they think they're putting 5 or 10% down as an investment. They could end up owing everything that they've got and going out of business. So I think that there's a lot of chance for them finding out that this was something they never wanted to be involved in. They're also acting like long-term end users, buying and holding it. You know, we want speculators that are willing to get in and out and use the short side as readily as the long side.
Why,
well,
Peter?
I need to make a few corrections on some of the things the other guest just said. First of all, it's nobody's business to tell pension plans how they ought to invest. If they can invest in ExxonMobil and ExxonMobil owns commodities, then a pension fund can invest in the commodities itself.
But is that risk appropriate, though, Don?
Pension funds do not just put 5% down on leverage. They generally do not use leverage at all. They're not permitted to use leverage under ERISA that regulates them. And number three, they do not act like long-term users because they never take delivery.
But what about that risk
factor,
though?
They keep their futures positions on permanently. They are not hoarders. They are not consumers.
Don?
Yes.
What about the risk factor? Are futures simply too risky for a pension fund to get involved in?
Futures don't have any greater risk than stocks or bonds or any of the other things that pensions invest in. And the reason pensions are doing this is because you can reduce overall portfolio risk by adding a risky individual asset that is not correlated with all the other assets you already have. That's modern portfolio theory. That's
Peter,
the
you've heard this
application of
argument
science to
before. A
investing.
lot of folks argue this. You have a little bit in commodities because they are not correlated with any other market.
Exactly.
Why don't you buy into that, Peter?
Well, I mean, you know, you talk about risk. I mean, this is the oil market back in '91 when we went from Desert Shield to Desert Storm. This is a market that traded at $35.80 that night, and then the next morning was at 18 bucks. I mean, you know, we move much faster and much more quickly than these guys are prepared for.
But pension funds have seen that happen in stock prices as well.
Well, you know, I just don't think it's a useful vehicle for them. You know, they got 5,000 stocks they can trade. There are 25 actively traded commodities. These are strategic things that consumers rely on. They're distorting this market, and you know, there are plenty of other places for them to get the action they need. They should stay in their own markets, as far as I'm concerned.
All right, we got to go at this point, but gentlemen, thank you for your time and your views on this, Peter and Don.